Justin Butler here from Eclipse Financial Services with another of our short videos. Today's topic is personal insurances. So this is talking about how the insurances financial planners use, like life insurance, trauma insurance, disability insurance and income protection work. Basically the best way to think about it is the severity, I guess, of the sickness or accident that's happened to someone. Of course, the most severe thing that can happen to someone is they can die. Probably the next most severe thing medically that can happen to you is you can be totally and permanently disabled. Be that something like put in a wheelchair or some sort of brain injury where you might be a functioning person but you simply can't do your job anymore. I guess the next level would be a major medical trauma. The most common ones here are things like heart attack, stroke and cancer. Those sort of things nowadays you can be affected quite severely, but within a month or two you can be physically able to go back to work, but you may not want to go back to work. And then I guess after that you've got disabilities, which can range from a car crash or something that might keep you off work for a couple of years through to a broken leg or an arm or the common cold that may only keep you out for a few days or weeks. The different types of insurances and the way they work, basically there's lump sum insurances. So with lump sum insurances you're selecting an amount of cover that you want, $100,000, $500,000, $1 million, whatever the appropriate amount might be. And if the ailment happens to you, as described in the policy document, they will pay out a lump sum of money that you can use to repay debt, invest for future income, look after your family, that style of thing. So lump sum cover is available for death. Lump sum cover is available for total and permanent disability where you'll never work again. Lump sum cover is available for major medical traumas. The other type of cover that's available is income protection, where you're not going to get a large lump sum of money. You're going to get a monthly payment if you're off work through sickness or accident and you can't earn your normal wage or business income. So I guess the key with income protection, it will cover any medical reason you're off work, which may be broken arm, broken leg, bad car accident, if you have to take time off work through a trauma like cancer, stroke or heart attack, but only the period that you're off work, or total and permanent disability. The variables with this are how long do you wait before your first monthly payment kicks in. Can be as short as 7 days or as long as 6 months. Depends on things like how much sick leave you've got accrued, whether you've got a bit of basic income protection in your super at work, how much cash you've got in the bank, that style of thing. Obviously the shorter the waiting period, the higher the cost. The other thing is how long will they pay you the monthly amount for if you're off work for an extended period. So you can have a policy that will stop paying you after 2 years, or if you pay more you can have one that might go for 5 or right through to age 60 or 65 if you can't work. So these income protection works in together with lump sum covers. If your income's important to your loved ones and your family for their lifestyle, then lump sum life insurance becomes important. If you die, that income will cease. So generally a lump sum of money means debt can be paid off and money invested to provide an ongoing income and education for kids and so on. You may also need lump sum cover for total and permanent disability and major medical trauma, but you'd also want income protection ideally for the more minor things, and it can work in with these, i.e. if you've got a good income protection policy that's going to pay you right through to retirement, you may not need as much total and permanent disability cover. Some portions of these covers can be tax deductible, certainly income protection is, and other lump sum covers can be written through superannuation with the premiums deducted from your super, which may free up the ability to do more salary sacrifice or something to top your super up and ensure it doesn't affect your end retirement too much. So that's a bit of an overview, I guess, of how the insurance system works. Financial planners will sit down and look at your individual situation regarding debts, dependents, income levels, affordability, and structure a package of insurance with an appropriate insurance provider who likes or is good value for money for your particular occupation and any medical conditions you may have, and work out the appropriate levels of cover for you. Lots more info available on our website in our education centre, and thank you very much for listening.